Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's dive right into one of the key technical areas where US GAAP and IFRS diverge, how they handle provisions and contingencies. We're going to break down exactly how these two frameworks force companies to look at future uncertainties and why it really matters to the numbers. And really, this is the question at the heart of it all. At what point does something that might happen become something you absolutely have to record on your books? As we're about to see, US GAAP and IFRS give two very different answers to this. Okay, so here's what we're going to cover. First, the basic problem they're both trying to solve. Then we'll hit the all-important probable threshold, talk measurement and discounting, look at some specific contract differences, touch on reimbursement assets, and then wrap it all up with the bottom line impact. Let's get into it. So you've got two sets of rules trying to solve the exact same problem. How do you properly account for a future loss that isn't certain yet? But the way they get there, their technical approaches, are pretty different. And those differences can seriously change how a company's balance sheet and income statement look. The very first hurdle, and you could argue it's the biggest one, is recognition. Before you can even think about booking a liability, that potential loss has to cross the probable threshold. And this is really where we see the first major split between US GAAP and IFRS.
And this is where it gets really interesting. Look at the language here. Likely to occur versus more likely than not. Now, to an everyday person, those might sound pretty similar, but in the world of accounting, there is a huge gap between those two phrases.
So for US GAAP, when they say likely to occur, the street interpretation, the one everyone uses, is a 75% or even higher chance of that loss actually happening. That is a really high bar to clear before you're allowed to recognize a liability. Now, flip over to IFRS, and it's a completely different story. More likely than not just means, well, over 50%. And this is huge, right? This lower bar means that for the exact same set of facts, an IFRS company will often recognize a provision much, much sooner than a US GAAP company. All right, so let's say you've cleared that first hurdle. You've decided you have to book something. The next question is obvious. For how much? And again, the standards take us down different paths, affecting both the size of the liability and how it's valued over time. And this is a really key practical difference. Under US GAAP, if you've got a range of possibilities and no single number is a better guess than any other, you have to book the minimum amount in that range. IFRS, however, wants your best estimate. If you've got that same range of equally likely outcomes, you're going to use the midpoint. Let's put some real numbers to this to see how it plays out. Imagine a company's in a lawsuit. Their legal team comes back and says, look, we think the loss is somewhere between $1 million and $1.5 million, but we can't get any more specific than that. And boom, right here, you see the difference. The US GAAP company, they book $1 million, the absolute minimum. The IFRS company, they book $1.25 million, the midpoint. It's the exact same situation, but there's a $250,000 difference on the balance sheet, all because of this one rule. Okay, next up is discounting. This is all about the time value of money. Under IFRS, it's pretty simple. If the effect is material, you have to discount that future liability to what it's worth today. US GAAP, on the other hand, is way more restrictive. It's basically an option, and only if you know the timing and amounts for sure. So what does that mean in practice? You see discounting way more often with IFRS. Now, these theoretical differences, they really come to life when you look at stuff businesses deal with all the time, like getting stuck in a bad contract or going through a major restructuring. Okay, onerous contracts. This is a big one. An onerous contract is just a fancy way of saying you're locked into a deal where the costs are going to be more than the benefits you get out of it. It's a loser. Under IFRS, the second you know that, you have to book a liability for that future loss. But US GAAP? Nope. It generally makes you wait for some specific trigger event, like actually shutting down the factory or leasing. That's a huge timing difference. And you see the exact same kind of thinking with restructuring. IFRS looks at the whole picture. Once you have a detailed, formal plan that you've committed to, you can recognize a provision for the entire plan. US GAAP is much more piecemeal. It makes you recognize costs one by one, only as they're actually incurred. Again, this tends to push the expense recognition further down the road. Okay, so far it's all been about the liabilities, the bad news. But what about the good news? What if you expect someone else, like an insurance company, to pay you back for that loss? How do you account for that potential asset? And this is where the tables completely turn. To recognize a reimbursement asset, US GAAP uses that same probable threshold we talked about before, that 75%-ish bar. But IFRS? Whoa. It hits you with a much, much higher hurdle, virtually certain. And let me tell you, virtually certain is about as close to 100% as you can get in accounting. It makes it way harder to book an asset for a recovery under IFRS. So on the asset side of the equation, IFRS is actually the more conservative standard.
So let's bring this all home. We've waded through all these technical details. What's the bottom line? What does this all mean when you're actually looking at a set of financial statements?
Okay, let's tie this all together. Big picture. IFRS, with its lower probability threshold and its onerous contract rules, is almost always going to make companies book provisions earlier. And because of the best estimate rule, those provisions are often going to be for higher amounts. Then you throw in mandatory discounting and that super high virtually certain bar for any recovery assets. Well, the takeaway is clear. IFRS will generally show higher liabilities and lower net income compared to a US GAAP company in the same situation. And that really leaves us with the big question, doesn't it? On one hand, IFRS recognizes potential problems earlier and more broadly. On the other hand, US GAAP waits for a much higher degree of certainty before anything hits the books. So, which one is actually giving you a more faithful, a more true picture of a company's future obligations? Well, that's at the very heart of the debate over a single set of global accounting standards.